Good evening, everyone. So I'm GS Agarwal. I'm CFO of Shriram Housing Finance Limited. I would like our honorable panel.
Hi, I'm Pankaj Gupta. I'm the Chief Digital and Marketing Officer at Karnataka Bank for the last 3.5 years. But prior to that, I was on the other side with companies like Wipro and Sifi Technologies in the managing the business.
Hi, my name is Ajit Menon. I'm the EVP and Chief Operations Officer for Vivriti Group. We're primarily an NBFC, which lends to mid-market companies, largely, anywhere between revenue ranges from 100 to 500 crores. Been a banker, managed operational risk with Standard Chartered for the last 6.5 years. Was based in India and Singapore. Now with Vivriti for the last 2.5 years, leading the group from an ops perspective.
Hi, I am Anand Aggarwal. I heads IT and security for an organization by the name Elets Care and Reconstruction. So we are basically into the stress assets buying. So I will say that when the job of NBFC and our job starts. So there's an old age saying na in Hindi, there used to be ad comes on TV, daag achhe hain. So I think that's what we also say NPAs. The more the NPA, more the business for us. So I have more than 25 experience in the industry. Work with company like Vodafone, Infosys, and ICICI Bank.
Hi, I'm Sunil Yadav and I'm head of technology for the Satin Creditcare Network Limited. It's NBFC microfinance, and I have 15-year experience in the technology. And I am from a core. I am a developer, and prior to that, I worked for Amazon. I worked for the IRCTC and all. Thank you.
Hi everyone, good evening to all. My name is Thiru. I'm a Chief Operating Officer at Kinara Capital. Over 25 years of experience in microfinance and micro enterprise lending institutions. So Kinara is a NBFC fintech based out of Bangalore, working in 6 states with around 2,700 crore of portfolio size. Happy to be here, and thanks for the Elets for organizing this.
Thank you, everyone. First of all, good afternoon. We are the last panelist here, so please bear with us. My name is Paritosh Tripathi. I'm one of the founding member at Signzy. Been part of the company since last 6 years. Prior to Signzy, I have co-founded a QR code payment startup in early 14, 2015, I must say, which got acquired in 17, and post that I've joined Signzy. So that's a brief introduction of mine. Looking forward to interacting with you all. Thank you.
So, as we say, every cloud has a silver lining. So, the advent of demonetization in late 2016 and immediately followed by COVID 2020. So, we saw that we have been forced towards digitization. Everything from paying electricity bill to utility bill, groceries, paying for our cabs and regular day-to-day thing, everything we have to use digital payment method now. So this fintech app and helped us, and especially with the advent of UPI, when the payment, receiving payment, making payment has been become very easy with our mobile phones in hand. So every time we don't need to carry any cash, we just have our mobile phone and that's it. We can buy anything. We can buy from a car to a small pin. So that has simply changed our life significantly. So I have a question with my panelist, how we are coping with this change, which has come so rapidly in last 5 to 6 years time. And it has completely changed our lives. So my first question is to Ajit. So in the context of digital transformation, what major changes do you see in the way our business was done, say like 5-7 years back versus how it is done today?
Right. So I'll just quickly touch upon, I think, some pertinent points you made with respect to the ease of transacting. So one big thing that has got solved for today is friction. So today, if I have to order food, for example, I have to log into a food delivery app. The popular ones are integrated with many payment systems. So the apps are intentionally designed to take out friction. What I mean by saying that is from food discovery to selecting the menu, selecting the dish, and to making a payment, you can all get it done in under 3 or 4 seconds if you're Absolutely. Really fast, right? So it's not by accident that friction was solved for. Friction was solved for with an intent that you want to be a repeat purchase customer who would need to come again and again. And it's integrated with wallets and companies like LazyPay and companies like Simple, which enables you to buy now, pay later. That again further takes the friction down because you don't need to input your card number, you don't need to put CVVs. So what this has done in the last 6 years, it's become very easy to consume. And we are primarily an economy which operates on consumption, right? So let me draw a parallel from this to the financial services space. Today, we as an organization, and I'm not here to market my company, let's say we are sub 10,000 crore in AUM, we are essentially branchless, right? And we run multiple portfolios, and we don't operate with a branch. All this is centrally managed, and the money is digitally disbursed. The due diligence is the amount of time you take to make a decision, data aggregation. Today, everything is available at a fingertip. It's just that it's proprietary. So if you were to draw a parallel as to how money was distribution, so what if money was distributed, what you're essentially solving for is access and speed. So today, technology has enabled you to provide access and speed and distribution. So it's solved for these three things rather, which has really cut the total time to market. So from ideation to really solving a customer's problem when it comes to a particular financial product, I can do that in under 3 months, which would take maybe 1 year in the past. So it is access, distribution, reduction of friction, and largely customer convenience that's being solved for. And this is only going to get better. So I hope that I answered that.
Yeah, that's right. I can understand because I personally come from a lending institution, which is a completely traditional lending institution.
Right.
So we have a brick and mortar, we have 130 branches or almost 2,000 employees,
Right.
and we do lending by a traditional mode.
Right.
But yes, we also use a lot of fintech, a lot of applications which are plugged and play in our ecosystem, and then we take use of it.
Right.
So
Absolutely. So I think it's just solving for friction.
yeah.
And solving for ease and distribution largely.
Pankaj, my question to you, with the advent of fintechs, how do you see the traditional lending institution coping up with the recent changes like us?
Actually, interesting question. I'll probably give a little bit of a longer answer in terms of statistics. What you call as traditional lending institutions or banks, we have 137 banks, nearly 1.2 lakh branches, nearly 1.35 trillion deposits, 900 billion US dollars worth of assets, and to top it, currently without fintech and without all the digital rails which government has built, we have been doubling this every 5 years. And one unique thing is that globally there are certain aspects about this traditional lending institutions which you talked about is globally best NPA rates ranging between 3% to 5%, globally best capital adequacy ratio rates at around 18%, and globally best ROEs at around 15%. Let me come to the other side, though this is the traditional lending institutions, but obviously, fintechs have really been innovators. They have brought common sense, they have brought technology, they have brought customer experience at the center, and they are doing such great innovation. And no doubt, a $30 billion industry is projected to grow to around $400 billion by 2030, right? And it's a no-brainer with the kind of market available in India. UK Sinha talks about nearly $29 trillion rupees of credit gap just in MSME. This is what is getting filled by partnership between fintechs and traditional lending institutions. The good part about lending institutions like us is that we see three things happen very fast. When we look at, and it's a no-brainer, it's partnership, right? It's innovation coming with strength. We are looking at experience, we are looking at efficiency vector. And I think that's been in play for a long time, especially for banks like Karnataka Bank. Efficiency vector in terms of onboarding people like Signzy. Efficiency vector in collections, UB platforms are here, so Spocto. So interesting things are happening on the efficiency vector and continue to happen. Underwriting by Perfios. But what is of interest now is the access vector. And Axis Vector is about really partnering together, building those bridges together between either two regulated entities. And now with our RBI, yesterday there's a very clear guideline which has also come out in terms of FLDG rules. So it's the regulator has also been very progressive to encourage innovation and partnership in a very controlled way. So this is really going to open up access, and customer experience always has been there, right? So neo banks have been there. So all these three vectors are very important, and traditional banks and lending institutions like us in partnership can really deliver growth as well as customer satisfaction and also operational efficiencies. So it's a no-brainer that I would feel that we are benefiting more probably compared to what the fintechs are.
Yeah, I agree with you, Pankaj. It's a real advent of developing, nurturing partnership between the traditional finance companies with the new age fintech. Yeah. So my next question is to Anand. While we do understand that digitization makes our life simpler and faster, we also acknowledge that various risks are involved. So we'd like to understand, how do you manage and mitigate these risks?
So I think with this digitization, if we have to keep the trust of the stakeholders, the managing and mitigating risk becomes extremely important. Now, when we talk about risk, the risk could be technological risk, it could be the operational risk, it could be security risk, it could be regulatory risk. Now, in terms of all these risks, I think the easiest risk to solve is the technological risk. You put the multiple copies of the system, put the system in the high availability mode, have multiple redundancy in terms of bandwidth and other things, and then you are home as far as the technological risk is concerned. But I think when we talk about other risk, be it the security risk or regulatory risk or operational risk, that is where the major challenge lies, because that there we have a human element which is involved and integrated into it. Now, the first thing that I would rather say is that first you need to do the risk assessment. Identify all your internal and external factors. What is governing you? What is impacting you? What is the cybersecurity landscape you have? What are your crown jewels you have? Do the complete risk assessment of all those assets that you have. Now, once you've done those complete risk assessment, then next comes the step in terms of the risk management. Now, here again, you have to define your policies, procedures which are specific to the organizations. Now, once we do that, then comes the implementation part. Now, what could be the solution that I would have to deploy? When in terms of you have a role-based accesses, you have privilege access management, you have data security things which comes into picture. Once you take care of the data security piece, then how I'm going to help in terms of the data privacy part of it. Now, with this digitization, the data is available with everybody. Now, what do I need to do to ensure that my data is available to the people on need to basis only? That is another thing which comes into this thing. Now, among all these things, I think you can deploy the technology solutions. You can have best of the breed of the solution deployed. But the biggest, weakest link which we look at is the employee. I think employee awareness becomes extremely important. I think we all need to understand that when we talk about risk part from a digital perspective, it is not only the responsibility of the IT function. Everybody in an organization is equally responsible to ensure that we adhere to those this thing. Now, I was talking to one of the fellow member in the morning, and we would say that 90% of the risks can simply be eliminated by following the very basics. Now, what are the basics? Basics are like patch updates. You keep getting patch updates. Half of the machines may not be patches. We have seen many of the ransom attack which has happened in the past, where the vulnerability was exploited by the malicious people just because the patch was available, but if the half of the machines were not patched. You can deploy best of technology, but if you can't do these basics, 90% you're still exposed to the external factors. I think that is another thing which I would this thing. Now, from a technology perspective, see, as you rightly said, the space of digitization significantly increased post COVID, especially. Now, what is happening is that with this pace, the people with malicious intent have also drastically started coming to. I mean, we see that best of the organizations are being breached, best of the organizations are being hacked. I mean, so no security is the best security now. I mean, I think security, it is not that you deploy some X or Y product and you are home. I think it is a continuous journey. And what is happening is that each OEM comes to you with a different set of products. You buy this product, my product, this do this thing, my product do that thing. And you cannot deploy the n number of product, and you cannot have n number of resources being managing, because it's a finite number of teams you can have this thing. So you have to have some platforms which ingest the logs which are coming from multiple systems and give an actionable input to that IT person who is managing this thing to ensure that those actions are easily implementable. Otherwise, you can have, again, I am saying, you can have best of the solutions, the logs are being generated, alerts are being, hundreds of alerts are being generated. It is humanly impossible for a person to be able to manage or act on those risks, basically. So some solutions, you deploy some platforms which are able to ingest and gives you a actionable item typically to be able to take care of it. I think these are some of the points that I would like to highlight in terms of mitigating risks.
Yeah, it was well articulated by Anand. Yeah, I agree that with the increase of technology, use of technology in such a high extent, the risk factor also becomes much more increased. And we need to have a proper strategy to mitigate the risk in order to balance between the risk and the proper mitigation. My question is to Thiru. What strategies are you adopting to effectively assess risk, especially in case where traditional collateral or credit history may not be available?
Yeah, thank you, Rich. So, as I was mentioning, just to give a context, like we give pure unsecured loan in a kind of a blended fintech kind of a model. That's what we say blend. Why we say that is we totally rely on, it's like a high tech and high touch model. So we use technology from an LOS perspective, starting from everything, from either the PAN check or a bank statement analysis, or every endpoints we are being integrated with different vendors to do the technology part. So what we say is, there are three things which I can say is, one is the even though we are using technology, but our field risk assessment remains the same. So we don't skip that for any customers, even for existing customers. When they come for a repeat loans, we don't skip the field risk assessment. So every file is being visited by the credit team to analyze whether the data entered is whether it is right, or what is that, how do we verify those data, all those things. That is one angle. See, when we say that we are not dependent on the collateral, because we do collateral free lending, the most important thing is we rely on the cash flow based assessment. The cash flow based assessment is from different sources. So one is the banking source and another is from the GST. So how do we use different models to assess the revenue and also verify that during the field visits is one of the things. So we don't rely on whatever the projected statements, or all on the only the declared turnover or something like that. We assess their own, come out with their own cash flow statement and P&L statement based on our own models. The third thing is, how do we use our own data to validate their revenue and also to take a loan decisioning. So that is where the whole, whatever the 90,000 loans we have disbursed, we have data about 150 sectors and more than 350 subsectors in different geography. Say, for example, a textile power loom in Kolhapur or Ichalkaranji, what will be the revenue if the family size of 5 or if the laborers are 3, compared to a guy in Tirupur having a textile company with 10 laborers or with a family. So that's the data which we use for our own data science model, which is helping us to mitigate the risk from a cash flow income perspective, from a field assessment perspective, and from the data science model perspective with all the data. This is where we feel that even though it is unsecured loan, we are actually giving a right loan, because we reject almost 75% of the credit bureau approved files. So it's not from the login. So that way we feel like, okay, maybe it is little bit, people can think like it is little bit more, whether it is inefficient from an operational perspective, but from a risk perspective, because we generate more leads, this will take it up. And the last point is, having said all of these things, the collections also plays a very important role in risk mitigation. That's where we use data science model in two ways. One is the early warning signals. How do we capture early warning signal before the bounce? How do we increase the monitoring? How do we increase the reminder process? All those things. And second thing is the collection priority index model. After the bounce, which customer, through what action, in what interval, if I monitor, the probability of repayment is high. So that is a very rich model. I can talk about that also later on. How do we do with the pre-disbursement data, post-disbursement repayment pattern, and also most importantly, the monthly scrub data we generate from the credit bureau on a monthly basis on our customer, whether they are paying good with us or not good with us, whether they are good with others. So all these data helps in collect monitoring. So it starts from assessment to decisioning and then in collection. So all these three things, when we string together, that's how we are, I think, having unsecured portfolio of 2,600 crore with less than 3% NPA. That says that this is kind of working well. Thank you.
Yeah, I can relate to that because we also like do mostly in the assessed income because we also cater to informal segment, and 80% of our customers are also informal, and the entire credit decision is based on the assessed income only. Yeah, so thank you, Thiru. Sunil, so what are the key opportunities and challenges that arise from adopting technology-driven solutions for various lending activities?
So question is, it's like that tricky question. It's I am saying it's so how can we take that question? So it's like that opportunity in crisis. So in another sense, so we also doing a complete traditional business of the loan distribution. We are doing a microfinance. I am taking an example of ours only. So 3 or 4 year back, we are using a traditional way to sourcing the clients and doing the risk assessment and all that process. So that process is very tedious process, and it's going to take around 15 days to process a single microfinance loan. 15 days. So it's a big number. So by adopting a technology, so at today, I just give you a glimpse. At today, we are doing a eKYC completely, a digital KYC, account verification is happening, credit bureau is happening, and then there is a AI based or ML based models to evaluating the documents as well as the human face recognition. We are let binding the let long on the each and every touch point of the client. So all these parameters are going to be a big help for us in sense of client frauds, identity frauds, and client mapping. It's like that. It's a high touch business. Microfinance is a high touch business. It's like around we have 8,000 plus employees. Those are servicing those loans continuously. For example, if someone is source of 400 files and after that he put their paper, so hard to track those clients in the earlier days. But nowadays, each and every touch points we are collecting all these datas. And apart from that, there is account aggregator stuff for evaluation of the account statements on which we are sourcing the loans or dispersing the loans is another aspects. So technology is enhancing the efficiency by way and meanings, because it's reduced almost life cycle of the loan by the 10-15 minutes for one single loan. If I am talking about the repeat customer, if I am talking about the new customer, so it's maybe a half day process to disburse the loan. And there is a lot of fraud to the disbursements as well, as it's a completely a cash business in the earlier days. But due to the technology, everyone, it's 100%. It's not just my organization, all microfinance institution at point of time, it's completely disbursing their each and every single loan in a digital pattern. So, and people are saying around into 2019, I'm using a हिंदी वर्ड्स कि माइक्रो फाइनेंस में कैशलेस वैशलेस नहीं चलता है, डिसबर्समेंट नहीं चलता है. And within a year, industry is scaled up to the 70 or 75% for the disbursement pattern, and today is 100%. Not even a smallest one is disbursing a loan in the cash. So it's all about the adoption, technology adoption, and each and every single microfinance are well equipped with the technology solutions. Few of them working on their in-house systems; those have the capacities, and other are using the standard solutions which is available in the market. So technology adoption is giving a great help to the industry, particularly the microfinance. Microfinance is a rural women's. We are servicing the rural women's where we are doing the all that stuff, e-signature, e-stamping, e-KYC. So it's only through our technology. Yeah.
Thank you, Sunil. Due to dearth of time, I quickly move to Paritosh. Paritosh, how do you expect a customer-centric lending ecosystem adapt to the changing expectations of borrower in the digital age? And how do you think you can mitigate the fraud risk?
Thank you, sir. First of all, I must say that all the esteemed panelists have covered it all. I'll just add my bit here. I'll quote one of the veteran in the industry, Nandan Nilkani. What he has said almost when I started my first company in payment, and I was just seeing that video which he presented to K Capital, which is a K Start, Clary Capital, I would say, initiative. He said India gonna become data poor to data rich country. And in last 10 years, it has happened. If you see the India stack, what it has done, it is no brainer that borrowing or any sort of a lending product gonna penetrate on its own. I think Pankaj sir has very eloquently mentioned a lot of data, which I can resonate. I think India has immense potential. We are just scratching the surface. We might be saying here while sitting here that we are doing our bit, but believe me, there's a 100x that needs to be there. So just to summarize, we point that how things are happening. I think as mentioned by Ajit sir, after the advent of e-commerce and hyper local deliveries, customers expecting even banking and asset product like the same sort of experience. And they're not wrong about it, correct? The way you're ordering Uber, why shouldn't you get the loan? Correct? As a banker and as a, I would say from the ecosystem play, it's our job to ensure that how we can ensure there has to be a seamless experience while we are doing relevant underwriting, risk mitigation, using AI, ML, and all the rails that we already have in place. So just to name few, yesterday we had a great news. RBI has now allowed for FLDG. I think that's a great move. Without having fintech on the distribution side, I think nobody can scale. So that's the first great move. I think that's gonna really impact the things. Second, I think advent of platform like a protocol like account aggregator. I think it's a very early stage. It's a day one, but I firmly believe that we shouldn't be wasting our time scanning those bank statement and underwriting the risk of Photoshop. I might say that my accuracy model might be 98.8% and somebody might say might be on 100%. But in India, I think one thing which we have cracked very well is to handshake between two organizations. It has happened with UPI, wherein we have created our own switch. Now with account aggregator, I think FIU and FIP is doing amazing job. I think it's a starting. I think a lot of FIU is there, NBFCs are getting there, insurance companies are getting there, investment companies, AMCs are getting there. So let's think of 5 years down the line. You're gonna have all the data of the individual, what asset that they're gonna have, what insurance that they are having, what sort of risk that you need to underwrite. I think over the top of it, companies like us gonna play a vital role using our end-to-end digital onboarding and underwriting, which is also deeply integrated with dynamic scorecards, wherein you can use account aggregator, you can use alternative data. One thing I firmly believe that personal loans, BNPL, and everything is sorted. If you see the journey right now, a lot of folks are still getting the real-time disbursement. So I can get a personal loans in less than 5 minutes if I'm having a credit score and everything is sorted. I think we need to solve a few things which is still less penetrated, like SME loans, unsecured, for a ticket size wherein they are not getting right sort of a feedback from the right stakeholders. I think there itself, I think we should look into a very different perspective that how we can create a model with help of the ecosystem so that we can penetrate the lending products in tier 3, tier 4 cities, majorly for the business side, because you have 100 platforms for giving away the loans for individuals. And respective of both sides, I'm talking about secured and unsecured. But I firmly believe FLDG, account aggregator, alternative data, and with the advent of data rails that we have, so we have Aadhaar. So in India, all the OVDs are validated, correct? It's Aadhaar, PAN, driving license, passport, voter ID. Player like us are doing the verification in real time. Similarly for underwriting, correct? If you see, for salary class, there's a EPFO, there's a credit score, there's a bank statement. We're using account aggregator. In times to come, you can also get the AMC's assets. What are the mutual fund SIPs that person is having? So all these things are already out there. You just need to underwrite it and disburse the loan. On the collection side now, you have an ENACH, you have a mandate 2.0. So I think we have thought through. I'm not saying that everything is working in a bit, but I think rails are there. We just need to have it in a place wherein we can optimize it and efficiently use it at scale. Last point on the risk mitigation side, how we should mitigate the risk, because sitting on this side, it might seem very different that why we are not doing the digital lending, why we are not giving the loan to everyone. But on the right side, I could see a lot of esteemed panelists which are seasoned bankers also. And believe me, I'm just 30-year-old. They might have experience of 30 years. So my perspective might be very different. But what I believe is technology has done a pretty decent job in underwriting and to mitigate risks. So just to give an example, nowadays you can validate anyone. Either they are using VPN, are they masking their IPs, are they trying to do face match frauds, or they are trying to spoof the identity, or they are trying to change the make and model of the phone to tamper any sort of an application or an ID. And those things are already available. It's just how somebody is using it and how efficiently they are using it. So I firmly believe that risk mitigation is something which we're gonna do while we're gonna evolve as a country or as a ecosystem. In digital days, nothing is secure. We all know that. We shouldn't be living our life in illusion. But what we should do is we shouldn't create a bottleneck for ourselves by just talking about too much risk. Every business has their own risk. We just need to underwrite in the most efficient manner. So that's my closing remark. I hope I've able to share my thoughts with you. Thank you.
Yeah, Paritosh, you have covered it well. So our time is up. The screen is showing. So thank you so much. Very happy to be a part of such an enlightened panelists. And thank you everyone for joining me in this panel discussion.
Financial technologies, right? They largely leverage various data points, and once the data becomes available through the formal channel now, so account aggregators, channel, so and so forth. What is
Sorry, could you just repeat that? I'm sorry.
So I'm saying most of the modern fintech companies who are lending, right? They thrived on the availability of data from various sources, non-traditional data and all that. Now that becoming your privacy laws coming into picture, with the account aggregators formalizing the data sharing, what is the edge for these financial technology modern lending companies you see, apart from, of course, the ways to reach out to customer, making their lives easier from the lending perspective?
So if you recently were on Twitter, on my Twitter feed, and I think that's the buzz. I would not want to take the name of the gentleman, the CMD of a very large financial services company with AUMs exceeding 65,000 crores very recently said, in a public forum that I'm sorry that you're, irritated by the pesky telemarketing calls that you get from my company. But in 3 months from now, you will get an opportunity to go and, express that you're not interested. But at the same time, we also have the right to ensure that we forget you. So that was slightly cocky, but in my view, the interplay, I think it's an interesting question. Only time will tell how these laws will get enacted and will come, and the tenability, etc., and the application, the use cases are too many. I think it will become more democratized. It is not about the data availability, it's about what you do with it. You could have a 5G smartphone with 100 GB data on it and could give you, 500 Mbps of download and upload speed. But if you really don't know what to search for on the phone, then I think there's no point having that speed and the data capacity, right? So it's the mode is what you do with it, how you smartly underwrite. So I think Paritosh mentioned is there a template for institutional lending? That's what we are doing. We're trying to retailize institutional credit, right? So from due diligence, from product, from customers, from a prospecting stage to disbursement, we do it today in under 21 days. I don't think there is an NBFC which does that today, right? So what we are doing is we're building a proprietary, data lake which allows us the interplay of data. I'm able to essentially get a ringside view of what he or she is doing as an entity, and then make a decision to lend at what price point, right? So that is called democratization of data. These laws will only augment, and they will just catalyze where we get and how fast we get there. So interesting. We will have to wait and watch as to how these pan out.
So I'll just add or reinforce. I think, it's good to have a structure. So account aggregator, PCR, there's a structure of democratization. And especially for credit, I think that structure is only going to facilitate acceleration of underwriting, whether it is GST data or account aggregator or data to the bureaus, is primarily what is the external data required by financial institutions to underwrite. So it is only going to accelerate and facilitate. So privacy laws are good to give clarity so that people know, because unknown is where people become a little bit hazy whether we should do it, not do it. But with all these rules coming in, acceleration is going to happen.
Thank you very much. I think the question was only that the moat that existed between the fintechs and traditional banks might be narrowed, because traditional bank might still fill up the gap once the structure is available to them. But anybody's guess what happens, right?
It's the David and the Goliath, right? So both have to coexist. So one won't get eliminated, and that's not the way ahead. It's always going to be a way of collaborating, and that's how it's going to be.
Account aggregators, or most of the data that you're talking about, that comes from a structured system. From the prospect, which is already part of the system, the prospect which already has EPFO registered, or he's already with the banking system for a good amount of time. So we have data. But the problem statement is when you have a micro entrepreneur who is not part of the formal system, collecting data is a big challenge. Now, in that case, if we are relying on alternate data, so I just wanted to understand from Paritosh specifically, since they have done so much of innovation on the alternate data space, what kind of innovation you are doing and what kind of model you are adopting, so that we can gather information from such prospects, and those data can be used for underwriting. Currently, there's lots of reliance on personal discussion, video PD we are doing, but still it takes time. I think, thanks a lot, sir. I think this is what Ajit sir has mentioned very rightly so. I firmly believe that we both need to coexist. Just to answer that question very precisely, I'll take example. I was talking to one of the banker recently, and everyone is trying to understand from me that I understand Paritosh GST underwriting is clear. Everyone able to underwrite it from GST. What about those folks who don't have a GST? They might be below than 20 lakhs out of a slab, and how are we going to underwrite them? And they don't have any digital footprint available as much. And so I answered him in a very indirect way that I think this is a great problem to solve. I think, and the way we are solving it, I'll share a few things with you. I think just using a mobile number, correct? There's a lot of data footprint that is already available. Just to give an example, if I'll get to know about your phone number, I'll get to know which car you're using right now, just with that via phone number. So if I know about the car, at least I have some assets that is with your name, correct? That's A. Second, as soon as I have your name and your car, I know which pin code you're residing. So if I know that you can at least afford at least the rent of that place, or you have some sort of assets out there. The second data. Third data is nowadays, I don't want to talk about too much about data privacy, because in India, we never been taught about it. We always share our Aadhaar card like the way we are sharing our names. So if you take a consent from a customer very explicitly, you can also read their SMS, correct? You can understand what sort of an inbound and outbound that they are going through. That's the 3 data. Then over the top of it, you can create a lot of model to underwrite. Is this person is a greedy person? He's opting for loan from a lot of reasons. And the fourth point is, just to give you a reference, let's suppose I'm running a shop in a place wherein there's no digital footprint. And I need to get a POS machine. I don't have a GST, I don't have anything. You know how PAPG works, the new guideline which RBI has recently came up with. There's a lot of players in the market which claiming that I can underwrite, I can decide on MCC code and so on and so forth. But nobody is leveraging Just Dial, Google merchants, because whenever you opt for anything, you just search nearby. And every merchant in India is putting their list on a Google. Their shop is there, they are mentioning what they do, what they sell, how much they sell. If these are the data points, and which obviously these are alternative data points, correct? By collating all these things, the ones that I've told, you can get a great insight. And in times to come, if you see the companies like Slice in Uni, we can always talk about them, what they've done, what they've not done. And I'm naming them because they've done a tremendous job in penetrating the credit product to those folks who had never got it. Because it's a chicken egg problem, correct? First you need to get a credit, then you can get the credit score. Similarly, I firmly believe there is a space that is underlying, which is still not filled properly. How you can underwrite someone who may not have a GST, who might be a micro entrepreneur trying to start something or doing something not at scale, but they need a cash, but nobody is opting for it. Hence, there has to be a great collaboration between institutional side of it and players like us in the market who has a great data points, great models, which can be leveraged to provide great products to the end user. So that's my take on it.
Just quickly add to that point is like we also with the people who does not have bank, even the bank transaction and GST transaction, we do assessment of cash revenue through different proxy methodologies. Like we assess the revenue based on, for traders, for example, based on the square feet of the. So there is a small model based on the different data point, based on the size of the shop and the material which they sold, and based on the geography where they present, or based on, for manufacturing, we use electricity as an proxy indicator to calculate the turnover of the company, or we use the employee's salary, which we have proof. So wherever there are small data points available, from that, how do we reverse engineer? I mean, obviously the customer would give some declared turnover, but which one is the right one based on different proxy methodologies? That is one another small models we run for the cash revenue based businesses too.
And even the underbanked, just to see, I think the very terminology of underbanked, unbanked is fast diminishing. So that is actually almost getting non-existent. So what I'm trying to say is you can always do cash flow based financing. So I can look at your Paytm statement, and I can just finance you for the amount of money that you made that day, and I know that exactly that's the same amount of money that will come in tomorrow. So he'll be able to pay off his obligations. So there is a lot of cash flow based financing that's already happening. Proxy data is what Thiru mentioned, and a lot of secondary, tertiary data available to basically triangulate and come to a conclusion with about 95% accuracy that yes, this is what his cash flow is. In the event that you don't have access to his cash flow statements, there are many other indicators which can help you arrive at that, and your model can spit out the right data, for you to then take a decision whether to lend. If you have to lend, you have to, what is the quantum you would lend, and the tenor and the ROI, etc. So then it's a waterfall mechanism post that.
Yeah. Any more questions from the audience? Okay, so we wrap up.
Thank you for being patient with us. Thank you.
Thanks a lot.
Thank
Have a
you so
great
much.
day. Thank you so much.